In this TaxSlayer Pro presentation, we're going to cover the basics of the Qualified Business Income Deduction. Now, it's estimated that the new QBID, or Qualified Business Income Deduction rules, will affect nearly 40 million taxpayers this coming year. Our objectives for this presentation: we'll find out who's eligible, we'll have an overview of the deduction itself, we'll have definition of terms, and we'll go over a brief explanation of the general computation with a couple of examples. We'll attempt to provide some information and clarity that were provided by the final regulations, and we'll go over the details of what constitutes qualified business income and what's meant by a qualified trade or business. Now, first, we'll look at the eligibility for the deduction, an overview, and definitions of terms. So who's eligible? Who's eligible to take the qualified business income deduction? Well, taxpayers other than C corporations who have qualified business income, or QBI. Now, we're going to use these abbreviations quite frequently during this presentation. So QBI, qualified business income, from a qualified trade or business, or QTB. Or who have qualified publicly traded partnerships, PTP income, and Section 199A real estate investment trust dividends, or REIT, may take this deduction. Included are individuals, certain trusts, and estates. Now, this is qualified business income from tax years ending after December 31st, 2017. Now, we emphasize the word may be able to take this deduction. Partnerships and S corporations don't determine the deduction at the entity level, but they will pass through the information necessary for their partners and shareholders to claim the deduction on their individual tax return. So what is the deduction? Well, generally, individuals and certain trusts and estates may be entitled to a qualified business income deduction, or QBID, of up to 20% of qualified net business income from trades or businesses conducted directly or through pass-through entities, plus up to 20% of their Section 199A REIT dividends and qualified publicly traded partnership income. This deduction is limited to the lesser of these amounts, or taxable income minus net capital gain. Now, certain income from cooperatives is also eligible for this deduction. The qualified business income deduction can be taken in addition to the standard or itemized deduction. What you see on this slide is the basic definition. And again, the deduction is limited to the lesser of these amounts, or taxable income minus net capital gain. Now, other limitations may also apply depending on the taxpayer's taxable income. So, depending on the taxpayer's taxable income, the deduction may be subject to other limitations which depend on things like the type of trade or business, or the amount of W-2 wages paid with respect to that trade or business, and the unadjusted basis immediately after acquisition. And this is a really long term, generally referred to as UBIA, the unadjusted basis immediately after acquisition. It's the unadjusted basis of all my property immediately after acquisition held by my trade or business. So what is and what is not qualified business income? Well, QBI, or qualified business income, is the net amount of income, gain, deduction, and loss from any qualified trade or business, or QTB, including those conducted through sole proprietorships, S corporations, partnerships, trusts, and estates. Now, only those items that are included in taxable income are counted. So, for example, if you have a current year business loss or losses that are limited by the passive activity loss limitations, only the losses from the businesses that are allowed to be claimed on the current year's Form 1040 would be included in the QBI computation. In addition, the items must be effectively connected with the United States trade or business. And remember that income earned through a C corporation is not eligible for the deduction. Keep in mind that certain items that are reflected on the 1040 go to reduce QBI, Qualified Business Income. QBI is reduced by any deductions attributable to the trade or business, including, but not limited to, the deductible portion of self-employment tax, self-employed health insurance, contributions to qualified retirement plans, and also QBI is reduced by any interest expenses that are generated by borrowing funds to purchase an interest in a partnership or an S corporation. QBI is also reduced by any unreimbursed partnership-related expenses that are deducted on a separate line item on the Schedule E. Now, there's a number of items that aren't included in QBI in the Qualified Business Income. Items that aren't properly includable in taxable income, investment items such as capital gains, losses, or dividends, interest income not properly allocable to a trade or business, wage income, and income that is not effectively connected with the conduct of a business within the United States. And again, just to reinforce the point about U.S. trade or businesses. Also, we see here commodities transactions or foreign currency gains or losses are not included in QBI. Certain dividends and payments in lieu of dividends, income, loss, or deductions from notional principal contracts, and annuities unless received in connection with the trade or business. Moving on, some other items that aren't included in QBI, Qualified Business Income, amounts received as reasonable compensation received from an S corporation, amounts received as guaranteed payments received from a partnership, payments received by a partner for services other than in a capacity as a partner. Now let's take a look at a quick review question just to go over some of the things that we've spoken about. Who may not take the Qualified Business Income Deduction? Individuals, certain trusts and estates, or C corporations? And take a minute, think of your answer. And if you guessed C corporations, you're correct. Now, what is a qualified trade or business? Qualified trade or business is any trade or business operated by an individual or pass-through entity that's allowed a deduction for ordinary and necessary business expenses under Section 162 with 3 exceptions: the trade or business of being an employee, specified service trade or business or SSTB, and a trade or business conducted by a C corporation. And take note, the SSTB exception only applies if a taxpayer's taxable income before the Qualified Business Income Deduction exceeds an established threshold. So what's an SSTB? Well, it's a trade or business that provides services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, or any other trade or business where the principal asset of the trade or business is the reputation or skill of one or more of its employees or owners. An SSTB also includes any trade or business that involves the performance of services that consists of investing, investment management, trading or dealing in securities, partnership interests, or commodities. The SSTB exception only applies if the taxpayer's taxable income before taking the Qualified Business Income Deduction exceeds a specified threshold amount. Now for 2018, threshold amounts were $315,000 for a married couple filing a joint return and $157,500 for all other taxpayers. Those amounts are adjusted annually for inflation. And also remember that businesses conducted through a C corporation are also excluded from the definition of a qualified trade or business. Now, what's a Section 162 trade or business? What does that mean? Well, in general, to be engaged in a trade or business, the taxpayer must be involved in the activity with continuity and regularity, and the primary purpose for engaging in the activity must be for income or profit. Now, this excludes an activity that qualifies as a hobby. For interests owned in a pass-through entity, the trade or business determination is made at the entity level. So if a pass-through entity is found to be engaged in a trade or business, an owner of that entity can claim the deduction even if the owner is passive or does not materially participate in the trade or business. What about rentals, rental property? Rentals will qualify for the QBID if the rental activity rises to the level of a Section 162 trade or business. That means that the taxpayer is actively involved in the activity with continuity and regularity, and the primary purpose for engaging in the activity is for income or profit. Also, there's a safe harbor found in Notice 2019-07, and if the rental property meets the safe harbor found in that notice, then it will qualify as a trade or business. Multiple properties can be treated as a single enterprise as long as all similar properties are treated as part of that same enterprise. Commercial and residential real estate may not be part of the same enterprise. So how do you qualify for the safe harbor rule? Well, first of all, the real estate enterprise must keep separate books and records for each rental, and the owner of the property or an employee, agent, or independent contractor of the owner must perform at least 250 hours of rental services annually. These services can include advertising, negotiating and executing lease agreements, verifying tenant application information, collecting rent, repair and maintenance of the property, and management of the real estate. There's a lot that can go into accumulating the 250 hours of service. Rentals also qualify for the Qualified Business Income Deduction if the rental or licensing of property is to a commonly controlled trade or business operated by an individual or pass-through entity, sometimes referred to as self-rental. It's important to remember that material participation is not a requirement to be eligible for the deduction. Determining if a rental is a Section 162 trade or business is made without consideration as to whether the owner materially participates. Now let's look at qualified REIT dividends. REIT dividends are dividends received from a real estate investment trust, or REIT, and are typically reported on Form 1099 DIV Box 5. Any dividend received from a REIT, including REIT dividends earned through a RIC, RIC, except capital gain dividends under Section 857B3 and qualified dividends under Section 1H11, are considered to be qualified REIT dividends. Qualified PTP income. Qualified items of income, gain, deduction, and loss from a publicly traded partnership, plus any gain or loss recognized on the disposition of the PTP interest, not treated as a capital gain or loss, is considered qualified PTP income. If the PTP income is generated by an SSTB, specified service, trade, or business, then it could be limited to the applicable percentage if the taxpayer's taxable income is within the phase-in range, or it could be completely excluded if the taxpayer's taxable income is above the phase-in range. Also keep in mind that the qualified PTP items are combined when making the Qualified Business Income Deduction, Computation. Well, what about pass-throughs? Pass-through entities are not allowed to claim the deduction, but the income they generate may be qualified business income. As a result, S corporations and partnerships must provide the necessary information for their eligible shareholders or partners to compute their deduction. This appears on Schedule K1, Other Information. For estates and trusts, they can either claim the deduction or pass through the information to the beneficiaries so that the beneficiaries can claim the deduction. Split QBI items between the estate and trust and its beneficiaries, and report the necessary information items allocated to eligible beneficiaries, again on Schedule K1, Other Information. Continuing on with pass-through entity reporting, required items reported by S corporations, partnerships, trusts, and estates to owners are qualified business income, whether any trades or businesses conducted by the entity are SSTBs, W-2 wages, unadjusted basis immediately after acquisition or UBIA of qualified property, qualified 199 Cap A REIT dividends, and qualified PTP income. Domestic production activities deduction, Section 199 Cap A G, passed through from a cooperative. Each entity has to report all the necessary information so the shareholders and partners can compute their own QBID. Now, if we take a look at the start items there, whether the trade or business is an SSTB, looking at the W-2 wages, and the UBIA, these items are needed to calculate the limitations set by the thresholds. Now let's take a look at another review question. Rentals only qualify for QBID if they meet the safe harbor provisions in Notice 2019-07. True or false? Take a minute to think about it. And the answer is false. Failing to meet the safe harbor does not automatically disqualify rental activity. If the rental rises to the level of a Section 162 trade or business, then it qualifies. Next, let's go over the computation of the QBID, the Qualified Business Income Deduction. The general computation reads like this. The QBID equals the lesser of the QBI component plus 20% of the qualified REIT dividends plus the qualified PTP income, or 20% of the taxable income minus the net capital gain. And this taxable income gets calculated before the QBID. The deduction is up to 20% of cumulative QBI or qualified business income. And this 20% of QBI is referred to as the QBI component, plus 20% of the sum of any qualified REIT dividends and qualified publicly traded partnership income. This is referred to as the REIT/PTP component. And this deduction is limited to no more than 20% of taxable income calculated before the qualified business income deduction minus any net capital gain. And that capital gain, by the way, would include qualified dividends. So basically, we're looking at the lesser of the QBI component, or 20% of taxable income minus net capital gain. And remember that the QBID, the Qualified Business Income Deduction, can be taken in addition to the standard or itemized deduction on the tax return. It's a separate line item on the 1040. And what we see on this slide is the fundamental calculation of the Qualified Business Income Deduction. However, keep in mind, there are many intricacies to this law. Those intricacies can complicate the calculation for some taxpayers. Specifically, the items included in calculating the QBI component, which is the first line of the formula on the slide, these can differ significantly depending on the taxpayer's situation. So let's dive in a little deeper on that QBI component. The QBI component for taxpayers at or below the threshold is QBI times 20% reduced by what's called the Patron Reduction. Calculation of that QBI component varies depending upon the taxpayer's taxable income, again, before the calculation of any qualified business income deduction. For those taxpayers who are at or below the threshold, and once again, $157,500 for any filing status other than married filing joint. For taxpayers filing jointly for 2018, it's $315,000. Those are the thresholds. The QBI component simply equals 20% times the QBI, the qualified business income, minus any patron reduction. So again, what is the patron reduction? If the taxpayer is a patron of an agricultural or horticultural cooperative, they're required to reduce their QBI deduction. For taxpayers above the threshold, but within what's called a phase-in range, it gets a little more complicated because the QBI computation must be adjusted as follows. QBI, W-2 wages, and UBIA of qualified property reduced by an applicable percentage for an SSTB, W-2 wage and UBIA of qualified property limitations applied or phased in, and the QBI component is reduced by the patron reduction, if any. And again, this is for taxpayers above the threshold but within a phase-in range. Starts getting a little complicated. Continuing on with the QBI component, for taxpayers above the threshold and above the phase-in range, the QBI computation is adjusted as follows. The SSTB is excluded from QTB. W-2 wage and UBIA of qualified property limitations are applied, and the QBI component is reduced by the patron reduction, if any. And an SSTB is not a qualified trade or business for taxpayers with taxable income above the threshold and above the phase-in range. For situations where the taxpayer is above the threshold and also above the phase-in range, the important point to keep in mind is that for specified service, trades, or businesses, they are completely excluded from being a qualified trade or business, and that's because the SSTB is not considered a qualified trade or business for taxpayers who are above the threshold and the phase-in range. So as a result, no QBIA, no W-2 wages, nor any UBIA of qualified property goes for an SSTB. Those will not be considered in determining the qualified business income deduction for taxpayers who are above the threshold. On the other hand, 20% of qualified business income from each trade or business that's not an SSTB is limited by the W-2 wages and the UBIA of qualified property limitations. And again, as the slide reads at the top, when the taxpayers are above the threshold and the phase-in range. And then finally, the QBI component is reduced by the patron reduction, if any. Now we've been talking a bit about the patron reduction. Let's get a little more information as to what that reduction is all about. Patrons of agricultural or horticultural cooperatives must reduce their QBI component by the lesser of 9% of the QBI from the trade or business allocable to qualified payments, or 50% of W-2 wages from the trade or business allocable to the qualified payments. These qualified payments will be reported to the patrons by the cooperative for use in calculating the patron reduction. So they'll get information from the cooperative to help calculate any QBID on their tax returns. Taxpayers who are not patrons of the agricultural or horticultural co-ops will not need to report the patron reduction. Now let's talk about the threshold amounts in the phase-in range. For 2018, the threshold is taxable income of $157,500 or $315,000 if married filing jointly. Phase-in range equals the threshold amount plus $50,000 or $100,000 if married filing jointly. More than $157,500 to $207,500 or more than $315,000 to $415,000 if married filing jointly. Those are the phase-in ranges. And these amounts are adjusted annually for inflation. Now the taxable income is computed before the qualified business income deduction. Generally, the taxpayer's taxable income for QBID equals the adjusted gross income from line 7 on the 1040 minus the standard or itemized deductions on line 8. And that occurs in this area right here on the 1040. And you see the qualified business income deduction appears on line 9. Now for net capital gain, we mentioned earlier that the qualified business income deduction, the QBID, is limited to 20% of taxable income, again, calculating before taking that deduction, less the net capital gain. The net capital gain includes qualified dividends, and the net capital gains for Section 199A include qualified dividends from Form 1040 Line 3A plus the smaller of the amounts reported on Schedule D, Line 15 or 16. If blank or a loss, then your net gain is 0. And when Schedule D is not required, the gain on the 1040, Schedule 1, Line 13. Now let's get into loss netting on the QBI component. In determining a taxpayer's QBI component, the loss netting rule must be considered. So if a taxpayer's qualified trade or business, QTB, generates a negative qualified business income for the year, and generated a net loss in other words, then that negative QBI has to be netted against any other income from QTBs in proportion to their net QBI. If overall combined QBI is less than 0, the QBI component for the year is 0, and the negative amount carries over to offset any future year's QBI. W-2 wages and UBIA of qualified property from QTBs that produce negative QBI are not taken into account in the taxable year and are not carried over. Negative combined REIT dividends and PTP income. The deductible losses from a PTP must offset qualified income from other PTPs and qualified REIT dividends. If the overall qualified REIT dividends and qualified PTP income are less than 0, then the negative amount carries over to offset future years' qualified REIT dividends and qualified PTP income, but does not offset QBI from a trade or business. Now let's look at the computation of the QBID, the Qualified Business Income Deduction, at or below the threshold. And we'll start with a simple, straightforward computation. The taxpayer has taxable income before the QBID at or below the threshold. Now, as a reminder, the threshold is $157,500 or $315,000 for couples filing jointly in 2018. So for these taxpayers, the QBID is limited to the lesser of the QBI component, 20% of qualified business income, plus 20% of the qualified REIT dividends plus qualified PTP income, or 20% of taxable income minus any net capital gain. And remember that taxable income gets calculated before the qualified business income deduction is calculated. Now this is the general computation that you want to keep in mind as we go through the examples. In the QBI component, when taxable income before QBID is at or below the threshold, is QBI times 20% reduced by the Patron Reduction. And please note, the SSTB exclusion does not apply when you are at or below the threshold. So in other words, the qualified business income that's attributable to a specified service, trade, or business that is included in the QBI component if the taxpayer's taxable income is at or below the threshold. For these taxpayers, the specified service, trade, or business is indeed a qualified trade or business. And also note that the limitations based on wages and the UBIA of qualified property, these do not apply to taxpayers at or below the threshold. And this is why we refer to this as a simpler calculation. Now keep in mind that providing services as an employee is not eligible for the deduction. So let's tee up an example with some numbers. Richard, who is single, operates a bakery as a sole proprietorship. In 2018, he reported the following: QBI, $100,000, net capital gain, $7,000, taxable income before QBID, $81,000. So his QBID is $14,800. How did we get that? Well, QBI was $100,000, net capital gain was $7,000, taxable income before QBID, $81,000. The QBID is limited to the lesser of 20% times $100,000, which is the QBI, the qualified business income, in this case $20,000, or 20% times $81,000, the taxable income, minus the $7,000 net capital gain, which is the lesser, the $14,800. And so, remembering the general computation formula, Richard's QBID will be the lesser of 20% of his qualified business income, or 20% of his taxable income before the QBID minus any net capital gain. So when we look at the numbers here, 20% of the $100,000 qualified business income from the bakery is $20,000. Then we have 20% of the $81,000 of his taxable income minus his net capital gains, and that figure is the $14,800. So the result is that Richard's qualified business income deduction is line 9 of the 2018 1040, limited to the lesser of these two numbers, obviously the $14,800. For taxpayers at or below the threshold who are not patrons of an agricultural or horticultural cooperative, they can use a simplified worksheet found in the 1040 instructions for 2018. Now let's pause a second, take a look at a review question. The net capital gain for Section 199 Cap A includes qualified dividends. True or false? Well, if you were paying attention earlier, you know that this is true. Now let's look at another example. At or below the threshold, taxable income limitation. This is going to be a more in-depth example so that we can see how multiple QBI items interact. Now, in this example, we have Sherry and David, a married couple, filing jointly. For 2018, their only income is from two Schedule Cs. David has a startup construction business. He ended up 2018 with a $20,000 loss. Sherry's a doctor, and her sole proprietorship ended up with a $200,000 net income. All the items of David and Sherry's income are considered qualified income for Section 199 Cap A in this example. Now as we follow through, the $200,000 self-employment income generated a self-employment tax of $21,278, the deductible portion of which was $10,639. And Sherry also had a self-employed health insurance deduction of $5,000. So these items end up on the 1040 Schedule 1. Here's Sherry and David's Schedule 1 for 2018. The deductible part of the self-employment tax ends up on line 27, the self-employed health insurance deduction on line 29. Now we move on to the 1040. The items flow through to the 1040. The 2018 Form 1040 AGI 164,361. Standard deduction is $24,000. The taxable income before the Qualified Business Income Deduction, $164,361 minus $24,000 standard deduction is $140,361. So it's obvious that this taxable income for Sherry and David are below the threshold. And remember, the threshold is $315,000 for a married filing joint return. This is important because a doctor's office, like the one that's operated by Sherry, is a specified service, trade, or business in the field of health. So therefore, it would be subject to limitation or exclusion from QBI for their income above the threshold. But because the income is below the threshold, these limitations do not apply. So the QBID in this case, 20% times 140,361 equals 28,072. Taxable income, line 10, 112,289. Following through with their 1040, tax is calculated at 16,583. And other taxes from the SE from Schedule 4 on line 14, 21,278. And the total tax on their return, $37,861. Now, it was a bit beyond the scope of this presentation to get into very complex examples. We just wanted to show you a couple of simple examples on how that QBID will be calculated. Next year, for 2019 returns, the IRS has promised us, instead of worksheets, we may have some new forms. So what we want you to do is trust your TaxSlayer Pro software will do the calculations for you, and you should have a fairly easy time of calculating that qualified business income deduction. We want to thank you for watching this presentation.